So the US has announced broad sweeping tariffs to be imposed across many countries, ranging from 10% up to 50% effective immediately. The hardest hit countries are those with large US trade deficits, e.g. where the US imports a significant amount of goods. Goods from Vietnam will incur a 46% tariff, and China will incur an additional 34% on top of existing tariffs. Australia, on the other hand, was imposed with the lowest base level of tariff at 10%. The initial reaction from markets has been negative, selling off further from the declines seen in the lead up to this announcement. That reflects that fact that tariffs are higher and more widespread than had been anticipated. There are a number of negative implications stemming from the tariffs. They create inefficiency in global trade and may lead to trade wars as countries respond. They'll impose higher costs on US importers who may pass this on to consumers, resulting in inflationary pressure. They may also dampen GDP growth as higher import costs place pressure on margins. Bond yields have fluctuated on the news, but the general trend has been down as the balance of risks is tilted towards economic growth impacts rather than the potential inflation impact. For example, immediately following the announcement, Fed funds futures priced in 3 rate cuts in the US for 2025, up from the previous expectation of 2. With US 10-year treasuries falling from 4.7% at the beginning of the year to just over 4% now, this has shown how bond holdings can have a cushioning impact against equity market falls over this period. Market volatility is a timely reminder of the crucial role portfolio diversification plays in mitigating risks. We build our portfolios with this in mind to smooth out the bumps so investors can stay focused on their long-term goals. So what can investors do? One of the most important things is to understand that investing demands a long-term view. Volatility creates opportunities, particularly for investors focused on the fundamentals. Markets tend to overreact to news, so this is vital to step back and look through the noise. It's important to focus on companies that have long-term competitive advantages. We refer to them as having wide moats. They'll be able to maintain pricing power and weather the tariff impact. Secondly, adjustments in global trade dynamics may lead to a shift towards domestic US production, seeing a reshoring of manufacturing, which has been ultimately President Trump's main goal. This could provide domestic US opportunities. And finally, be aware of mitigating factors such as fiscal responses, both in the US and from major trading partners such as China. Government stimulus programs or tax cuts could help offset the tariff impact and create opportunities for certain sectors.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.